We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. This is a pre-recording of a Twitter Spaces live event that we hosted. If you'd like to be a part of the next one, go on to Twitter/Palisades Radio, and you can be part of the conversation.
Hey guys, welcome to Twitter Space here. Appreciate everybody showing up and joining the room. Obviously, a lot has happened here in the recent past. We've had some kind of whipsaws in the precious metals markets. We had the election, obviously. It's been a while since we've done a space. I'd like to start by kind of introducing a couple of our speakers tonight. We're going to have Bob Coleman, Jim Hunter, Steve St. Angelo, and Drew Rathgeber all speak, and then we might have a couple listener questions and stuff like that. But why don't we start with you, Drew? And it would be interesting your take as well on sentiment since the election.
Yeah, on my website, I actually wrote a blog post about there could be a fundamental change in the precious metals landscape, depending on the results. Kind of going into it, I thought, Trump being kind of the peacemaker, a lot of that risk premium could be sucked out of the metals, and I posted that about a week before the election. And then on the other side, if Kamala won, the geopolitical situation would keep the metals pressing higher. So I think a lot of that risk premium kind of popped out. I don't think the bull market is done by any stretch of the means. It's a small correction. It's not, if you go look at a monthly chart or even a daily chart, we're still well intact. And actually, I'm kind of sensing a little bit of a momentum change right now. When you have the metals go up that fast, that quick over the last few months, you're going to expect some type of pullback and go run out the weak hands. So it wasn't a shock to me. I see it as opportunity. You buy into weakness, sell on strength. So it's just creating a new opportunity for us right now. There could be some more downside, but my gut indicator is kind of sensing a little bit of a small time momentum change right now, kind of as we're talking. Not full force back into it yet, but we did go, I managed a large book of clients. We did go to cash, but, or they've got core positions where they're just sitting on it long term. But, it's not the end game for the bull market by any stretch of the means. And actually under the Trump presidency from 2017 to 21, gold went up by 52%. Trump spent a lot of money under his presidency. Added a lot of debt. And so if you just follow the debt ratio to gold, if that stays in play, then gold and silver will continue to go higher.
Mm-hmm. Well, there was an interesting, I did another interview yesterday, and an interesting data point that the gentleman brought up was that the divergence by the end of the 6 weeks after the election result in 2016 between the S&P and gold was something like 25%. So let's say the S&P had moved up 16% and gold had moved down 9%, giving you a total of 25%. I guess my question for you, Drew, is around these types of big events. You said you guys went to cash. Is that something you typically do around something as consequential as, and let's say unknown as an election?
Yeah, I was putting out my clients, I was definitely putting out the margins were being, there's a few things on my events. The margins were increasing at a rapid pace. That was a signal. And also there was a risk off situation. So it was just, it didn't really, everybody had kind of done so well, I would say, where we had been and where we were. It was kind of a risk off situation. Effectively, went to cash with quite a few of my clients. Now I will say a lot of them didn't sell on strength. They waited till it, one day at 4% decline. So a lot of them panic sold in that situation, which was, as an owner of a company, it's a little frustrating. But in saying that, it was a risk off situation. Now everyone's kind of taking a look at it. I know there's a lot of other people on X right now saying, it's going to be going down for 6 to 8 weeks, but typically year end, the metals do push higher. So we'll see what happens. We're not out of the woods yet, but I think year end we could have some surprises.
Mm-hmm.
While he's doing that, I'm going to go ahead and talk. This is Steve from the SRS Rock Report, and we saw the metals really take off. Silver hit 35, gold topped over 2,800, and that happened before the election. And then it wasn't a surprise that when Trump was elected, that we saw the Bitcoin take off, and then the metals have been selling off. So Trump has been talking about making U.S. crypto and Bitcoin capital of the United States. And I thought that was just to get the votes, but it seems as if that's what he wants to do. And so we see that the Bitcoin price has taken off. And so it looks like some of the flow of funds have moved out of the metals and have moved into Bitcoin. But I knew the metals were going to correct because we had such a big move in gold. Nothing goes up in a straight line, even though we're going to see 3,000, 3,500 gold, and we're going to see higher silver prices. Nothing goes up in a straight line. And so I just think we had that big move in the metals. I guess some people would like to see silver do better than 35. But since the election happened, Tom, then all of a sudden, kind of the crypto and Bitcoin took over. And so that's how I see the markets currently.
The part of the issues, I think, and I think a lot of people want to get into this topic of manipulation and so forth. But really, if you look at the last couple of weeks, you've had the big run in the markets have really been in the gold and silver markets have really been on the options, and the futures markets have been a big driver. But a lot of big players been getting in since August, September. It's been a popular trade. It was sort of the idea that really Trump was going to win, but the Republicans were also going to take a landslide in both the House and the Senate. So the idea behind it is that there's going to be a lot of spending if the Republicans basically have complete control, and that's pretty much what has happened. I think part of the issues is this recognition, sort of buy the rumor, sell the news. You had managed money, which was heavily long on the markets or on the gold, on the precious metals markets, and you've had basically just a rotation, profit taking, whatever you want to call it. But for example, last week you had about 12,000 contracts, almost $2.3 billion in notional value of outflows of the precious metals. Silver came off quite a bit as well. I think actually based on if you look at commitment traders report, you had definitely managed money closing out longs, increasing shorts, and possibly that was maybe some positioning going into the idea that if Trump wins, maybe some of the stuff unwinds, and so you start playing this ratio trade where maybe you go long the dollar and short the metals from the previous thing of shorting the dollar and going long metals. I mean, there's different ways a lot of these guys play it. It's more of a positioning game with CTAs and hedge funds. Sometimes they don't just simply go long gold or silver. They couple it with another trade to sort of either balance risk or hedge a position, that type of thing. But you definitely had a lot of unwinding the last couple of weeks. I know a lot of people looked at the 8 o'clock hour in the morning to 10 o'clock hour in the morning where you get this constant selling. We can get into that a little bit with the idea that as you're coming into the New York markets in the open in the mornings, the futures market is basically the COMEX. I mean, from a global standard, they have created this futures market. It's very popular to do these types of go long spot and short the futures. And I can get into the nuances of why they do that. But a lot of times it's either for hedging, it's to capture the contango, which is basically for people that may not understand contango. Basically, you have the spot price of gold and silver, and then you have a futures contract, lead month futures contract that people may sell forward. And there's a higher price that you get with that futures contract because it takes into account interest rates and the carrying costs of that metal. So a lot of times they may sell forward, say, for example, the December contract back in October, with the idea of trying to capture an annualized return of 4.5%, 5%, playing that roll game. And oddly enough, what managed money does is it can switch between long and short, but a lot of times when these funds go long the futures, it's actually you're buying a contract that is not designed for long-term ownership. It's designed as a trade or as a short-term position, because with futures you have what they call as you get closer and closer to the expiration of the contract, that contango constantly shrinks downward, and that's part of this EFP, or exchange for physical premium, where you take the spot price versus the lead month contract, and as you get closer and closer to expiration, that time value of money decays as well. So these futures contracts actually, from a long position side, aren't, unless it's a trade, they're not really great to buy on a longer term basis, because you're having a contraction of the price or the premium over the spot price. And Drew can kind of get into that a little bit, because he specializes more into the futures contracts. But that's one avenue that tends to have impacts with the exchange for physical premium between the spot price and futures price, and that tends to also give you a lot of clues to what players are doing in the market. If the exchange for physical premium is contracting, for example, faster, that could be futures related selling that's more one-sided than the futures market, then you see actual selling in the physical market. So that premium can contract faster. But these are just nuances that professionals watch for. And that has impacts on the price. The sad part about the COMEX, which I don't say sad part, but the part that most physical owners don't understand about the COMEX is it's a hedger's market. It's designed to be a seller's market. It's not necessarily designed to be price discovery for the guy who's trying to go long, from a standpoint that the futures have that time decay function. It's just the problem that we run into in the markets is that we all look at the futures market as price setting mechanism, but in reality, the commercials use it for hedging and also locking in these spread trades. And it's unfortunate, because from a physical owner's perspective, if you remove that sort of function from the price discovery mechanism, and people really just traded on the future or traded physical, you could have obviously a much different picture, but you may have wider spreads. There may be different things with it, but you wouldn't have as much influence, I guess, on price with the futures market. We are where we are. The system is designed the way it is. It's not the greatest thing in the world. It's not the worst thing in the world, but that's part of the, when you're buying the metals, that's part of the expectation is, the futures market. If you wanted to kind of chime in, Drew, just let me know.
Yeah, I mean, we're coming to the first notice. So we've been trading off the D's contract for the last few months. We roll 3 or 4 times, depending on how you want to roll, but we roll 3 or 4 times a year. We come in first notice, basically 2 to 3 days before first notice. Everybody's got to get out and roll to the next month. And quite often, going into those first notice dates, the metals will drop, not wanting to pay off those options. In fact, that's my opinion, those call options. So they'll drive the price down going into the first notice and then pop it after that. Is kind of been my experience. Not always, but often, So we are coming into a big roll, and we've been trading off the D's for quite a few months, I would say that. And it's speaking about the contango, yes, the contango will be kind of going back and forth, and then we'll eventually match up come about the 27th of November, I think is where the first notice date is. So, and just to let you guys know, Tom is logging in on his computer, so he's kind of had me take over. And Jim, have you talked yet?
No, thank you very much. Hopefully everybody can hear me okay. I'd like to remind everybody in the room what has happened here since October. And in the month of October was the high in the gold and in the silver contract. And they started back in February. And the move in gold was $600. We went from about $2,100 or $2,200 up to $2,800. So $600+ in the gold. And the silver finally got ahead of steam and started trading through 33, 34, 35. I'm sorry, up to 33, 34, and then 35. And now it's rolled back. So gold is down $200 since October, and silver's off $4 and a quarter, let's say, in the front month futures, which Drew said, he reminds everybody it's December. The next front contracts will be February for gold and March for silver. And first notice day will be the second to the last business day of this month of November. And all the spec longs, I don't want to speak for anybody, but all the spec longs will have rolled by then, because their futures commission merchant requires to fund their accounts with cash to take delivery if they don't. And a few people take delivery each month. There'll be more deliveries in December in gold than there was in August and September and November in gold. But we have had a nice move. And the laggard, the whipping child has been silver. And then silver kind of jumped up a little bit and hit $35.07 or $35.08. And that was it late last month. I think, like Steve mentioned from SRS Rocco, that we've got, a pullback, which is normal, which is healthy. They don't always go straight up. If you look at the chart, though, from February, if you look at a 1-year chart on a day basis, we had a nice move from the lower left to the upper right. And I'd like to mention to people, if you watch intraday charts, if you've got that capability to do that, I know people are working intraday, but the down days are brutal. If you can watch a minute or a 5-minute chart, they're just red candles all the way down. And it's because fear is more important than greed. Markets go down a lot quicker than they go up, and certainly $200 down. It took, in gold, it took just a week and a half, 10 days, 10 trading days. That's 2 weeks, 5-day weeks. But I think that we can find some support. I kind of thought, I was on Twitter last week thinking $31 was going to hold in the silver, and the trade tonight is $30.78 currently. So we got a little bit below that $31. I don't know if we've got a lot more to go. We'll have to wait and see. But I think that those are a little bit on the technical side, how big the gains were. A little bit on the fundamental side, the budget deficit in the United States keeps going higher. The foreign central banks overseas keep buying gold. Our federal United States central bank keeps buying paper. And if they would have bought gold 5 years ago, 10 years ago, whatever, they would have been a lot better off, because gold has gone up since, the 1100s, and we hit 2,800, and probably $3,000 will be, I'd go on record tonight saying $3,000 is the next big target for gold. I'll listen back, and I'll be back.
Steve, do you have any more input based on the current situation and your, long-term look at it? Or let's talk about this. We had a great conversation last night, Bob, Steve, and I, about the industry as a whole. All of us have been in the industry for a long time. Bob, do you want to make any comments about the kind of things that you've seen from the spot to the futures to, I know you've got your vault storage program, takeaways from our conversation last night for about an hour and a half?
Yeah, I think I was going to start off with it, in terms of just the retail transactional activity that we've seen this year, just in the retail industry, that's subsided quite a bit from the last couple of years. It's no surprise. You can take a look at and read AMARC's filings and public notices. They talk about how their activity and transactional activity has dropped quite a bit as interest rates and cost of carry has gone up with the hiking of rates and so forth. And then oddly, with this rate cut, you also had interest rates actually rise on the rate cut. That actually is increasing carrying costs for dealers as well. That, for example, a lot of dealers will hold inventory using a bank line of credit. So as interest rates start to rise back up, that's an extra carrying cost that they have to function into their profit margins. And then banks start to get nervous, for example, or they start to say, listen, the volatility in the metals are getting more risky. And that's one of the reasons why a lot of guys, if they use lines of credit, they're forced to hedge, because the bank does not want to take the risk the price risk of that inventory dropping and all of a sudden that line of credit going negative. Those are all factors that weigh on just the industry. And of course, as the industry has to hedge, they go into the futures markets and short futures contracts, or they go into the OTC market, into some type of structured program, that's run by a bank or bullion dealer or a big wholesaler that may offer hedging programs, things like that. But these are, you have that as well as the cost of hedging, as well as the higher cost of interest that's impacting the industry. At the same time, you have a lot less activity. You have more people selling back into the market. That's cutting and creating a premium war on, you would think, on retail dealers saying, listen, there's a shrinking pie and I got to get more of that pie. So therefore, I either have to increase my marketing efforts, or I have to start maybe cutting premiums to attract buyers. Those are things that are impacting. But oddly enough, the biggest tail sign of an industry slowing down is you have to look at the bids that retail dealers as well as wholesalers are buying back metals when clients go to sell. And that's where this thing has taken a turn really for the worst. If you look at some of the big online guys, they're $3 and $4 under spot that they're paying for silver right now. Silver rounds, silver 100-ounce bars. And these are the same dealers that were charging $5, $6 over spot for the same products just a couple of years ago. So what's impacting the market now is a lot of metals investors that, for example, may have bought the last couple of years, are thinking, okay, I can sell into the market, maybe make some money, but now they're finding that they're not even getting $30 silver when they go to sell because these bids are so horrible. And then you have a faction of the industry. You see a lot of this with the CFTC and the attorney generals that have gone after some of these California gold dealers that charge huge markups on quarter ounce gold coins or 1.25 ounce silver coins. People that had bought silver at $22, $24 an ounce, at 34, they go to sell and they find out they're just breaking even. And that's building a lot of frustration, I think, amongst the investor crowd that had bought physical metals and paid these really high premiums, or just didn't understand the spread risk that's in these products. And I think it's taken a toll on some of the sentiment, for the physical metal. And that's unfortunate, because it's something I talked about a couple of years ago, even on Spaces, that these premiums are going to come back to bite the industry, and that's exactly what's happening. And so, if David wants to chime in too,
well, I'll just back you up, Bob. I did hear I had myself muted, but I just want to reemphasize what you said. I think a lot of people that get the silver or gold story, honest money, however you want to frame it, and they buy and they're willing to pay this premium because everyone, it's a market, and there's a lot of other dealers that go along with kind of the flow, and it's a high premium. It's hard to obtain, all this stuff that you hear. And then they buy it, and now they need to sell it or want to sell it. I bought too much, and we shouldn't have bought this. I would rather have coins than bars, whatever it be. And now they see this huge discount to the spot price. I mean, I don't blame those people for walking away. It's like, wait a minute, I got kind of had on the way in, which I saw plainly. It's clear to see everyone else was doing it, but on the exit, I'm really getting a haircut as well. I mean, take an example like Bob gave. I don't know the exact numbers, but buying silver when it was in the 20s and the premium was huge, maybe paying 25, and now silver spot's 30 and getting 25 for it. I mean, that's very discouraging. And there's nothing really you can do in the industry because it's not regulated, and you can shop around as people should. And then there's a downside on that. I mean, I've been in the business long enough to know that lowest price doesn't mean delivery. I mean, there's been dealers that, I can name a few off the top of my head that did a lot of advertising and had the lowest premium, but they never delivered the metal. So it's a tough one. I'm open to ideas from you guys on the retail side. If there's something that, you might suggest that would help the average investor out there. I mean, the biggest one I know of is kind of corny, but it's dollar cost averaging, because as these premiums ebb and flow, if you do it over time and just stack more or less religiously, you're going to come out in the long run pretty good, because things are going to, get hot and cold as the market progresses.
Hey, David, good point. Actually, David, you and I go back a long ways. You don't know me, but I got my start at Monex back in 2003. You did a speech for us at Monex headquarters in Newport Beach, California, back in 2004 to the whole sales team with Mike Maroney. Do you recall that?
I do indeed. Sure do.
So I've known you known of you for a long, long time, and you speak very well about the premiums. And I've known about this premium, or I should say the spread premium game, for a long time. And I think what the average investor needs to understand is the spot market is really a collector market in a lot of sense. It can be an investment market, long haul, yes, but from a trading perspective, and that's why I started ProGoldTrader.com, is kind of educate people on the difference between a spot, collector market versus kind of a future transaction, and these massive spreads that people are succumbing to. And I know Bob's got a great program where he's one of the lowest spread guys with his vault as well. And him and I have talked in great detail, these spreads that these major, and like we were talking last night, the guys with the biggest marketing budgets that you see constantly on the internet usually have the widest spreads. And so those are typically the guys you don't want to do business with, because their spreads are so wide. They're making so much money off of you. And you can shop it out. Like I said, like Bob, he's got his service, which is he undercuts everybody. And then I'm on the futures arena, where there's minimal spread in that context. But in saying that, there's a lot of complexity with the futures and, the leverage or no leverage. It's a different ball game. But yeah, nice meeting you, David, after all these years. I don't know if you remember Dan. Do you remember Dan Wales at all?
Don't recall the name. I met a lot of people when I was down there that weekend.
Yeah.
And I have met a few that have come, years later, like you. I wanted to compliment you on your outline on the options market. I mean, I make a joke, you could almost set your watch with the algorithms with the delta hedge. The algorithms know how to move the options market far enough so that one side wins almost every time. I see it looks like Steve's got his hand up here from SRS Rocco.
Let's go. Steve, good. Are you there, Steve?
I'm here. Great. Hey, Dave, it's great to hear you. I think one of the things that we could talk about, and I would like to hear from David and Drew and even Bob, because there's the issue. I tend to look at it differently, and I get criticized for it. And when you understand the professional metals traders, the professionals are actually in the business of trading metal. They see it differently than the precious metal community that tends to be a buyer, or as Drew says, a collector of coins and bars. So when they see the metals prices really fall at a certain time of the morning a lot, they think that's the banks doing the manipulation. Where if you listen to the professionals, it's really the institutional traders, it's the CTAs, it's the spec longs, they're more pushing the price around than the banks. The banks tend to be short because they're holding the metal. And I made this point that when gold was starting to get to 2,800, people said this time is different, Steve. I don't think it is. And I proved that point because if this time was different, we would be seeing massive demand of physical gold in China and India, the United States. Jewelry demand would be going off the charts. And when we came out with the third quarter report from the World Gold Council, a central bank demand of gold had declined. China had really declined on its jewelry demand. India was still okay. But when you look, it wasn't really physical driven. And if this time is different, if indeed the dollar's in trouble and the U.S. Treasury market's in trouble, then you will see demand for gold and physical, because that's what the market is, right? It's not driven by contracts. It's driven by physical demand. And so the reason we see gold go to 28, it's been driven by contract demand. And so that's why I knew we would probably see a correction. And I don't see it as manipulation. I see it as the ebb and flow of the market, especially when you look at people buying gold, even big investors. Big investors, they're going to buy physical gold, or they could get futures. But if they're buying futures and they're not buying gold bars or coins, it's easy to sell that future than it is to sell, $10 million worth of gold bars. And so what I'm saying is that I would like to hear what David and Bob and Drew think about the so-called manipulation of the gold and silver price over the long term due to banks other than just typical trading.
I'll go ahead and go first. Probably haven't been consistent enough, but I mean, my main statement way back when the whole manipulation word came out into the sphere of precious metals, I said that you cannot manipulate the long-term trend. If you could, then gold would still be at $250 an ounce like it was in, the year 2000. It's, 10 times that amount. But what I did say is within that, you can manage, and I'm not trying to play word games, the market. I mean, the futures market does have an influence, and, it's like anything. It's the amount of supply and demand. So if your supply is huge and the amount of contracts you're selling, that's selling pressure like a stock or an automobile. I mean, if there's a lot of demand, price goes up. There's a lot of pressure to sell something, price goes down. But I just looked up what I wrote in the Silver Manifesto on page 99, trying to get a objective handle on, is it or isn't it and manipulated. And just reading from the book, it's at the bottom of the page. It says, advocates of return-based analysis argue that it's easy to generate large gains and large losses with a high level of risk. Similarly, it is difficult to generate large gain and large losses with a low level of risk. One popular risk-adjusted measure is the Sharpe ratio, developed by the Nobel Prize-winning economist William Sharpe. The Sharpe ratio equals the average return divided by the standard deviation of returns. A high Sharpe ratio means that the average return is high given the level of risk. Frauds and manipulations have a very high Sharpe's ratio. For instance, Bernie Madoff's Sharpe ratio was 133%, while the benchmark Sharpe ratio in the stock market was only 19%. The table below shows gold's overnight intraday Sharpe's ratio over different time periods. In the 2000s, the Sharpe's ratio is 167%, which is above the Sharpe ratio for the Madoff scam. So I would say within the realm of that more or less objective analysis, yes. But again, they can manipulate the long-term trend. I mean, I'm adamant about that. But what Steve said has a lot of merit. I don't think the banks do large position trading. They really don't have time to sit there. It is the smaller guys, the hedge funds, the managed money. I mean, a lot of people don't know the managed money that Butler talked about so much. That's somebody that doesn't want to trade futures, that gives their money to a manager that manages a futures account for them. But I think a lot of people got the impression that all they ever bought was a silver contract. No, those managed futures guys buy cotton, cocoa, coffee, the ags, the metals, and everything else. And they only have so much allocated to the metals market. Believe me, it's not very much. So that's kind of where I'm at. I really, and to get one more step further, I would lose an argument on manipulation with anybody, because if you go to all of the fines that have been paid, the word manipulation has never been in there. The word spoofing and some of these other words are in there. And if you talk to somebody that's worked on the floor, of course, now everything's off floor, but they'll tell you that, running stops is just part of the business. So there's a lot of ways to look at it. I try to be objective about it, but I'm almost tired of talking about it. I think, if you don't want to be in the market because it's manipulated, the market that is manipulated is every market. Why is that? Because the price of money is the interest rate you pay in the U.S. Treasuries, and that's manipulated, or that's more or less set by the bank, which it really shouldn't be. They should just set the discount window and let the market decide what the price of money is, but that's not what happens. They come up with this operation twist where they buy the long end and all that. So really, if the cost of money is in a credit system, which we have, touches everything that we buy, all auto loans, mortgages, and everything else. The whole doggone thing's manipulated. So I guess I'll stop on the rant.
I agree with you 100%. I've been in this business 20 plus years, and you deal with the guys who are kicking and screaming about the manipulation. I'm like, well, everything is manipulated. Deal with it and learn to make money and profit from the current system that's in place. And what I mean by that is the feds can come out, ratchet up interest or drop interest, at the in any second and tighten up the situation. So over the years, I've dealt with it. Then you said about running stops. I can attest to that. I've been running my own book. I've been a licensed futures broker since 2006, focused in precious metals, and I can attest to that. It is all about running stops in the day. No question about it. And that's just from my experience and from the way I watch my order flow, the way I watch my clients. And from my perspective, the greed factor and the fear of missing out factor are two huge factors when trading these markets. And it just depends. In the futures markets, it boils down to your leverage ratios and how you manage that risk. That's why I always tell people it's not so much about the direction of trade, it's how you manage that risk and how long you're going to hold in these markets. I can't tell you, it really is about shaking out the weak hands. And like we just went through right now, which I kind of anticipated with the big run up, we're going to have a turnover and shake out those weak hands. And I can look at my book and attest to that. In saying that, a lot of people did very well on the way up, but did they sell into strength? No, they sold into weakness. And that's generally speaking what the general public does is they always kind of sell into weakness, not strength. I can definitely attest to that.
The big move up is it made believers out of a lot of people as well. I mean, to go from $2,200 to $2,800 in months, that's a 2-year move. That's not a 6-month move. And that's what we had. And once again, all-time highs every single month in this gold. When we got, over $2,000, $2,100, it was high after high after high, month after month after month. And so now we sit back a little bit. But, I made one post here a while back that says the shorts don't get to win every time. And I think Mr. Butler, not to speak for him, bless his soul, rest in peace, but he was always of the opinion that, maybe some of these banks are texting each other or talking with each other, to ruin a bull market. And, he had evidence, and there is some evidence once in a while of it. But I think that if we can find some support in here, I think that we can visit 2,800 in gold, and we can visit $35 plus in silver. The next move would be 37, then 40, in my opinion, coming up.
One of the things that I've been asking a little bit here, let's say since the election and since these moves, is it doesn't really seem like the fundamentals have changed for these markets, but it doesn't also seem like the fundamentals really matter. We've talked so many times about the fundamental production deficit in silver, and yet that doesn't necessarily drive the price up like when we think it should. So my question to you guys, and feel free to chime in on this. When do you think the fundamentals matter? Have they changed at all? And is that, one of the more important things that we should be paying attention to, or is it kind of background noise at this point?
I think, Tom, if I can just chime in first, I think the fundamentals always matter. And that supply-demand deficit that you talk about, I think that is the one major positive characteristic for the coming years.
Yeah. I would probably say part of the flow of the market, just being in these markets for 30 plus years, if you're going to see $50 silver, there's a sort of pattern that happens, and we've seen it, twice already since 1980. But ultimately, what happens is it's the players that are short, whether they're mining producers, whether it's hedge funds that start to play the short side of the market on silver, or guys that are hedging physical inventory. But ultimately what happens is you have to build up some degree of skepticism in the market and work off the optimism. And these pullbacks do just that. They reset the market. they kind of level out the playing field from being too long in the market, like on the future side, and it starts to bring negativity in. People start betting against the market, and then what happens is the market finds a base, builds from that base, and all of a sudden it starts pushing higher, and then all of a sudden, anybody short the market starts to get squeezed, and the market starts to go to a new trading range. That's typically how it formed in the past. I don't see that as any different today. I think this move that you've had from this 35 or 34, high 34s into this pullback here, it definitely pinches the people and frustrates the physical investor that is like, well, why is this thing pulling back so hard? And it certainly wipes out, like Drew was mentioning, a lot of people that are trading options or futures and all of a sudden didn't get out, and the market moves so quickly that now they're kind of actually stuck or playing the hope trade instead of actually they become an investor when they should be a trader. That's just the market, the way it works. A lot of people look at the manipulation side. They look at when you look at the commitment of traders reports, you look at the swap dealers, for example. It's been a big thing on Twitter. People saying, aha, the swap dealers are massively short the market, which they weren't, where the producers were massively short silver back in the late 2000s and early teens. Part of what's been driving the silver market this last year and the buildup on the swap dealer side is you have to understand who these swap dealers are. They're not just banks per se. They're also the trading arms of the banks. They're the broker dealers. They're the clearing firms and so forth, but they're also authorized participants that trade and make markets for the ETFs. And so what you've had with interest rates rising from 2022, 2023, you've had basically a way to profit by going long the physical or going long the ETFs and then shorting on the future side and capturing what they call that contango or that sort of that difference in spread between a higher futures price and a lower spot price. And a lot of people in the industry on the professional side will lock in these risk arbitrage or riskless arbitrage types of trades where they can actually lock in a stated return. They're not as much interested as they may play the upside using options, but for example, their big position may be long physical short futures, and then with that premium that they get, they then go long maybe calls or something like that. There's different strategies, and there's a lot of them. But that's just one thing that professionals do. What's odd and what happened in March of 2020, if you go back, you saw the gold markets and silver markets implode when the stock market went down hard with COVID, and all of a sudden you had this big fast turn and move, and then all of a sudden the contango really blew out, meaning the spot market was kind of locked up because you couldn't be moving metals around because the logistics were shut down, mining companies were kind of shut down, everything was just the world stopped in a way, and all of a sudden a lot of the banks and clearing firms that and options traders and market makers that were maybe short those futures contracts to lock in that contango, all of a sudden the market locked up, and now they were forced to cover or start to get out of that short position because they couldn't get to the physical metal because it couldn't be moved because of all this the logistics issues. That shot gold, for example, went to a $76 premium over the spot price, and I think you had some of the biggest banks out there, their trading arms lost tens of millions of dollars that day. Just like when oil went negative, Interactive Brokers lost like 30 some odd million that day. And so you have some of these odd events that happen that does catch these clearing firms and trading and market makers off guard and bullion banks off guard. But at the end of the day, they're just playing that contango and the exchange for physical premium spreads that typically work like clockwork when it comes to time value of money. I mean, but people don't stand on the physical world. And a lot of retail dealers, they talk about manipulation, but the loudest people that talk about manipulation are the ones that actually profit from that narrative. and they're using that narrative to sell a service or a product. And that's the frustrating point when it comes to professionals like Drew and myself that are regulated. We can't say those kind of things because if it's not accurate and correct, and if it's misleading, we could lose our license over it. And that's the unfortunate side of an unregulated market, is a lot of retail investors get caught up in that hype. And then, these dealers use that as a narrative to basically not only hard sell metals, but also try to get the most premium out of those metals as well. And that's unfortunate. But from a professional standpoint, the metals are a financialized asset. They're very pervasive in the financial system, and gold and silver for a lot of these players aren't just simply buy and hold vehicles. They use them for collateralization of loans, for financing, for hedging, or for using that as a ratio for another trade. I mean, there's multiple different uses that gold, and that's one of the reasons why I've always liked gold and silver, is that, and it has a deep market, is because of a lot of these players that have created structured products that allow the retail, for example, dealer to actually hedge their inventory. Otherwise, if you didn't have a futures market, it would be very difficult to actually hedge. It would be like the rhodium market, where the spreads just get gigantically wide because there is no futures market, or there's no market in London that actually provides a way to hedge. So there are benefits from a futures market, but unfortunately, in the U.S., I would love to see a spot market, an exchange that is based on physical activity with no margin. I think that would, even if the futures markets, the attractiveness of the futures markets is it could trade with some pretty massive margin. That brings a lot of activity and volume because people don't have to put a lot of money down. And in a way, you're kind of dealing with, like with the casino, but like with casinos, the odds are kind of bent toward the market makers.
Bob, one of the other things I was going to ask you, you mentioned this price of silver driving up towards $50. Talk a little bit about how long it would actually stay there, and if you think that is the top, or like, is that the target for a lot of people? Is it, obviously it's going to be speculation to say if it's going to go higher than that or anything, but what are your thoughts there on how long it would actually stay at a level like that? And David, maybe you can weigh in on that too. Anybody else?
Yeah, I think and Steve does some really great work in this area with cost of production and so forth. And you can see there is a floor that the metals tend to gravitate to on that cost of production equation. And so, and that's one of the beauties of silver right now, is that cost of production is, I think, 26, 27, 28, somewhere in there for the primary silver producers. And it's rising as inflation rises. And I think people look at the Trump election, and I try not to be political on this, but at the end of the day, a lot of the people that are pro gold and silver also are pro Trump. So there's, the idea that, okay, our guy now is in office, we can breathe a little bit better. We don't have to stress out as much. Maybe we don't buy as much gold anymore because he's going to take care of the economy and take care of the country. It's interesting, though, that there was a think tank in Washington called Committee for a Responsible Federal Budget, and they looked at the campaign promises and the campaign structure that both Kamala Harris and Donald Trump were proposing, and they did the numbers and number crunching and so forth. And basically, with his spending and budget over the next 10 years, basically they're looking at the deficit growing on an average $7.75 trillion going into 2035. And on the high side, I think there were 15 trillion. On the low side, there were 1.65 trillion. But the idea behind it is, with the Republicans getting basically a blank check because they now have all three structures in House, Senate, and presidency, they can kind of control the fiscal spending. And at the same time, if they start lowering taxes, the idea is that may blow out the budget deficit even more. It certainly is going to give the economy a lift. The question then is, is that lift going to be inflationary? And I think that's even the research that I kind of look at from some of these big houses out there, JP Morgan and so forth. That's actually the funny thing is everyone kind of says the banks are manipulating the markets, but actually if you read JP Morgan's research, they're very pro gold. In fact, their thesis is that there hasn't been a sea change. It's still a long-term good position that they're looking at much higher prices in gold in the gold market because of the idea that inflation is going to come back. You have the Fed cutting rates at the same time. You're going to have a lot of fiscal spending and so forth. So that hasn't changed. I think it's just right now we're just dealing with the knee-jerk reactions of the election and what people's expectations are and that repricing of those expectations and nothing more than that. That's one of the reasons why you kind of have to separate the futures market and the trading activity that has short-term impacts on the market versus the physical owner, which is what I am. I run a hedge fund. Just for full disclosure, it's physical metal. I'm not hedged because the longer-term picture tells me that the market is going to have to move higher. It's an inflate or die scenario. There's no way to manage the amount of debt and the debt servicing without some type of inflationary attitude. Now, at some point, this game bubble may pop and so forth. But right now, I think the metals markets, it's constructive to see this sort of ebb and flow of this pullback because you definitely have killed a lot of the sentiment that was happening even 2 or 3 weeks ago. I mean, you're seeing these retail dealers on YouTube spouting $150,000 gold. I mean, it gets ridiculous after a while. And it's unfortunate because a lot of these people pile in. They get caught up in the price. They get caught up in the emotion of the markets. But that's just part of that's how the industry kind of lures people in, unfortunately.
Let me jump in here real quick. Actually, Bank of America, you said JP Morgan, and Bank of America, Michael Wildner sets a target of 3,000 an ounce mid-2025. But I just read a report earlier today, and they were saying by year end it could be 3,000 according to them. And I will say this, Trump ran on lower interest rates. And if he does lower the interest rates and central bank buying, these would be definitely drivers for the precious metals to go higher in the foreseeable future. So just want to back up your JP Morgan statement.
Tom, your question was, what's it going to do at 50? We're asking specifically silver. I think that my own opinion would be, we've been there twice. I think that if we got near $50 and we kind of traded back and forth a little bit, I don't know for how long, 5 days, 10 days, something like that. But I think that we can get through it, especially if gold is over 2,800. That gold-silver ratio, it's favoring silver in my opinion right now. I don't pay that much attention to it though, but with $3,000 gold and a 50-to-1 gold-silver ratio, you can be right at about $60 on silver. So to answer your question, Tom, I believe that we'll trade through $50. We might back and fill a little bit around 50, maybe $3 or $4 back and forth a little bit, but I'm kind of heading, my goal would be getting through $50 on the upside.
And I think a big part of that too, Jim and Bob, that's obviously a big round number, and there's going to be a lot of selling and buying around that number. I would say especially selling because of that, let's say, psychological level, right?
Well, I guess, Tom, I would use the alternative gold, and gold didn't have any selling at all after it went through 21 or 2,200. I don't want to say at all. It backed and filled a little bit, but that line from February until October, that's a pretty nice incline of an uptrend. And so gold made new high after new high after new high. And if gold is over 2,800 again, going into the end of the year or whatever, or early next year, I don't think silver, because the old high is $50, if you use gold as a proxy, silver can make new highs too, Tom. That's my opinion.
Well said, Jim. David, do you have anything to add there?
Yeah, I pretty much go along with Jim. No one knows, but I have a hunch. Usually when you get a big resistance, it usually takes more than 3 tries to get through that resistance. So my best guess is we hit 50-ish and it backs off, and then all the silver haters. Oh, see, it'll never get above 50. You know, we got the 52 and now it's at 46. And I don't think it'll have to build much of a base. And then it'll go through it for the fourth time and probably go. And that's going to startle some people. And then what do you do? If you're in industry and you have to have it for your end product and it represents, 1% of the total cost of your product, you're going to buy it at 60, 70, 80, 90. You're going to buy it because you're out of business if you don't have the silver. Speculators, depends, what the algos do, but an all-time high, I don't rule out. I think what's going to be interesting is when it does get through 50, I believe that it will. And the big question is how much beyond 50 will it get to? And I forget who asked the question, but it was earlier on. And, once you go parabolic, it's really tough to keep your emotions intact and to take profits. I mean, I've called every top so far with luck, skill, or combination thereof. But, this next one will be pretty tough because if it's commensurate with a belief that the dollar is failing or that the new system is in or the CBDC is actually going to take place or all these fears that are out in the marketplace as far as what are we really going to do with this big elephant in the room where we've got this deficit that we can never grow our way out of, and the new or next monetary system's coming into the fore. I still wouldn't rule out $100. So I don't know. But the tough part, I think, and this comes from experience, is when you get into that parabolic move and you tell people to take profits. If I take profits too early, I'll probably ruin my good name, because people want to get the tippy top, but that's a amateur's look at the market. No one sells at the exact top unless it's pure luck. You want to sell in the strength. And, we have a hedge on or position in the metals because there's nothing better in this type of climate as far as owning money. I mean, really, it's really savings of the best kind is what we're really doing. And I'm a capitalist at heart. I like to put money into projects that benefit not only me, but society at large. That's a paradox about being a true conscious capitalist. But I probably went too far. But I think we will get through 50, but I think we're going to stall out before we get there. Or, stall out at that area and then move forward.
How about Steve? We haven't heard much from you tonight. How do you see that $50 level as well, Steve?
Yeah, well, I just want people to understand, I look at the markets in two different periods. I look at what's right in front of me, which is the short term. And some people want to understand, well, what's happening, kind of give you some idea of where the price is going to move. And that's due to what I call business as usual. And that's cost of production and then supply and demand. And that's also including futures and options and contracts. And so that's still happening. And now I could get upset and say, God, with all the debt we're printing, it should be 50 or 100 easy. And I don't disagree with that. Actually, I see much higher metals prices, silver and gold in the future. The issue is, how do we get there? And we get there due to the issues we're having with problems with energy. And that's the reason why we're printing so much. We're trying to offset the issues. We're not growing as much energy as we used to. And energy is a driver of the economy. So to make up for that, we're just issuing a lot of debt. And this is pushing up the cost of everything. So what I think is, and I did this analysis, and I go by these long-term charts. If you want to look at a long-term chart, look at this 60-year annual chart of silver. And when you put the 5 exponential moving average, in 1980, it hit $14. Well, guess what, Tom? That was the cost of production when oil had shot up to $30, when it was $1.80 just a decade ago. But what happened is the oil price fell, the costs fell, and the silver price came off that $50 spike. But it's still, for that year or two, it was $14 to produce silver. Well, guess what? When the oil price fell, the cost to produce silver was like $5, $4 or $5, and it remained there for 2 decades. And then what happened in the 2000s? The price of oil went to $100, and the cost to produce silver shot up again. So when I look at the exponential moving average on the yearly chart of silver, you know what it is? It's 25.75. The cost of production is 26. So The issue is the reason why gold is outperforming silver, and it's kind of frustrating to be a silver investor, but I still think silver is going to outperform gold, is because guess what the exponential moving average for gold was in 1980? It was 400. You know what the exponential average now for gold is? It's 1900. It's increased 5 times. Guess what? That's the cost of production. And so the reason why gold is going up much higher in percentage terms, and it's kind of frustrating the silver investor, because this market is based on cost of production, supply and demand, and gold just cost 5 times more to produce it. And silver, it went from 14 to 26. It's only $11 more, even though we had those big spikes to 50 and 80 and 2011. So going forward, I think as we continue to print all this money, we're going to lose confidence in that treasury market. And then people wanting to move into silver to protect their wealth. It won't really matter what it costs to produce silver. Then you're going to see the demand pull the price up well above the cost of production. And that's when I see silver remaining at these high levels, not coming back down. But I think by 2030, in the next 4 or 5 years, I think we're going to see the cost of production go over 35 and even higher. So we're going to be seeing spikes to 50 and 75 when we really get into trouble with all this finance, all this debt out there. So that's kind of how I see it.
Thanks, Steve. Don Mann, you've been waiting patiently. We'll take a couple questions. We'll take your question and then Eastern as well.
No, I appreciate it. I kind of mimic what the last person was saying as well, just trying to look at this because the investor psychology, and that's what I was trying to wrap my head around listening to everybody in the space, is you have a sort of a fair evaluation of it based on the market, trying to understand the cost side of it, the cost plus model. And then you have the investor psychology. And I'm trying to figure out, if you look at the cycles of the silver, of the price of silver, what would you say the percentage, so to speak, of where people look at silver valuation, meaning are they looking at it as a hedge against the monetary policy that we're seeing, or would they, meaning what during the peaks of silver, what was driving it? And if you look at as a percentage I want to say that was it this what we're seeing now with this government deficits as such, that we have to wait to that point where people are looking at silver as the answer to correcting this debt crisis. And right now I'm seeing the crypto, specifically Bitcoin, as taking the attention away from silver. And at some point, do people move away from the crypto into silver? And was that it was crypto having not been in the past cycles? Does this complicate when the timing of it happens?
If I could just interject, and I'm going to have Steve answer this question because he blew my mind today with what he kind of uncovered with regard to Bitcoin and Tether and what's actually happening in the Bitcoin market and also in Tether, and how what we thought was actually, if you want to talk about manipulation, Steve can give you, I mean, I'll let him kind of answer this because it ties right into this whole idea of, how are we going to fund all this debt and so forth, and how are we going to keep buyers buying all this debt? And at some point when they stop buying, that's when I think, this second coming is basically going to happen. But I'm going to have Steve kind of talk about this.
Okay, thanks, Bob. And Don, I think the reason why, and even David could probably talk about this, the reason why we saw silver go to 50 and 80 or 79, 80, as well as 2011, that was not physically driven. There were the Hunt brothers were buying some silver. That was futures driven. So there's two ways to drive the price of the market. We could drive it by physical, but it tends to be, that's the physical tends to be the long-term price. And David even talked about this. You can't manipulate the long-term trend. The futures market can move around the price much higher. And that's what it did in 1980. And that's what it did in 2011. Same thing with gold. And we're kind of seeing the same thing right now. I think we're going to get even more of a correction in gold and silver before we hit the next leg higher. But yes, Bitcoin has stolen some of the show. And in a nutshell, the Bitcoin price really took off in 17 and 18. And there's been two professors out of Texas that actually went through 2.5 million wallets and did the research and found basically with Tether, one large whale was kind of moving the price around. And now they seemed that the same thing was happening in 2023. And get this, when Tether, there's 125 billion now, Tether. So when Tether started to really increase its market cap, that's when the Bitcoin price took off. Well, they really haven't done an audit, but guess what backs all the Tether? Most of it is US Treasuries. So the funny thing about Bitcoin and its move higher, which was actually due to Tether coming into the system, which is a stable coin. And if you look at most of the trading of Bitcoin now, it's done through Tether, not through US dollars. And so what's happened is have all this liquidity. It's basically Bitcoin is kind of backed by the US Treasury debt, which it shouldn't be, because that's what's really driving the price of Bitcoin and Ethereum and a lot of the cryptos is Tether. And so I think people need to understand that going forward. I don't believe assets should be backed by debt. I think the best assets to own are physical gold and silver.
I think they're actually, I saw the other day, I don't know what the actual quantity is, but they're buying physical gold too, not just treasuries.
And my question in this whole thing is, you're looking at this because there's a great book by George Gilder called Life After Google. And he's saying that you need this conversion of gold with Bitcoin, or at least a crypto for transactions, but you still need the stability of gold or some type of real asset for creating the value, a stability of value of the transactions. And I can't, it just seems like we're seeing a transition into real things. There's no easy way for people to produce money. Instead, they have to produce useful things. And I'm kind of you're seeing this transition happening. And I'm just trying to figure out, is there any, from a geopolitical standpoint, when you look at the world and Russia and say China, and they're looking at this manipulation of the market, I would think is strategically, what are they benefiting from suppressing the price of silver? Is there anything by manipulating silver, do they gain in manipulating in a way where they're purchasing in the black market? And I'm making kind of an assumption here, but do they gain from the suppression of silver at this point in time in trying to minimize the dollar's supremacy at this point in time?
Don, that's a great question. I'll give you my 5 cents on it. The main reason from all my, look at this market for so long is at one time there was the Silver Users Association. And basically they were all the big players in the silver market from the industrial side. Tiffany's, Kodak, 3M, all those type of companies. And they formed the Silver Users Association, and their mandate was more or less to keep the price of silver near the cost of production, which again, Steve has done such an excellent job, showing that to everybody. And so that's kind of spilled over for all these years. So even though, the price moves around the futures market and you can do delta hedging and moves the options market at options expiration, all the stuff that, I know about, which is not adding to the conversation necessarily. But if you really want to look at why there was a reason, it was the users wanted to get a good margin. They're willing to pay the cost of production, like most commodities, cotton, wheat, cocoa. Okay, we'll give them what they produce it for and a little more, and then we'll get these large markups for Kodak film and Tiffany's jewelry and all this stuff. So that's part of it. I want to circle back to what Steve said. He made a really good point about maybe this time, silver goes past 50 and it stays there. One thing I pointed out, most people aren't aware of, is when silver did that spike intraday and hit 50, actually 52 in the near futures. That whole year, it averaged $20. For the whole year, that was the average price. The all-time high a year earlier was $6. So silver actually was 300% or more greater than the all-time high a year previous after it did that spike high. So I think Steve makes a really good point, and I wanted to kind of back him up on that we might overshoot, but we could see silver go to, pick a number, 150, and then it drops down to 85, and it stays around that for monetary purposes. And the last thing on the crypto, don't get me started. I mean, I did a whole thing. If you go to the website, morganreport.com, and hit the blog, go to the search engine and type in crypto conspiracy. I did 30 podcasts on what's going on in the crypto world that, in my studied view, took a lot of money that would have ordinarily gone into gold and silver and put it into the crypto market. So I think I covered everything I wanted to. Great discussion. Thanks for inviting me on, guys.
The reason I say that, I just see, I've seen some of the states looking at trying to open up, I thought Utah in particular, and having greater investor interest, greater investor participation in the silver gold markets, where they would buy it and the state treasury would hold it. And then you'd have like Visa providing a credit mechanism to basically use the value of whatever they were storing at the state treasury. So it's essentially you're creating almost like during the Depression, a new script in the case that somehow during some type of new monetary system reset, that you have a competing currency at the state level, like we saw during the 30s, which people forget about. There was all this, I don't know, and I don't even quite understand the mechanism of what actually occurred, where there seemed to be not enough currency in circulation, so people started creating their own script. So it seems like certain states are taking the steps to at least create alternatives for preparation of something that may come here.
I think that, and I posted this today, and this was partly, it was Steve kind of enlightening me, but there was a post that had a video with Howard Lutnick, which is the CEO of Cantor Fitzgerald, and he did a presentation at one of the Bitcoin conferences. I think it was in July. And if you follow that and what he's saying, and he's basically telling you that the more Bitcoin goes higher, the more money goes in the Tether, the more Tether buys U.S. Treasuries, and not to mention, I think Cantor Fitzgerald is one of the big primary dealers. I think from what Steve was telling me, they're I think it's up to 28% of the daily volume in U.S. Treasuries. They trade that on a daily basis. Well, the idea is basically that Tether is, the higher Bitcoin goes, more money goes than Tether, the easier it is for the U.S. government to fund its deficit spending, and which is totally contrary to what all these crypto guys are saying. Well, Bitcoin is going to be, it's almost as if Bitcoin is being used as a poster child to attract money that I think you see Janet Yellen kind of front loading U.S. Treasuries with a lot of T-bills and not a lot of long dated paper to try and keep the longer rates down as much as possible. But I think gold and silver, the oddity with gold and silver is they can't attract that money and have it go into T-bills, because a gold and silver coin or something like that would be going into physical metal, which would obviously be a competitor to the U.S. dollar. But I think that's what I kind of got away from what Steve was saying. You got to watch that video that I posted. It will, and I'm sure David's probably done, talked about this ad nauseum on his podcast.
Yeah, and I'd like to add just one thing. Dom had brought up that Tether was buying some gold. They do have some gold. They've got about $3.5 billion worth of gold. But when you look at their last three-quarter 2024 report, their assets, $85 billion is treasury bills, and $12 billion is repurchase agreements. And so when you add up it's basically $97 billion in that kind of U.S. Treasury funding. And so most of the tether, and now this is not an independent audit. They're telling us this is what they have. It's really never been independently audited by a professional auditing company. But this is what is backing Tether, U.S. debt. So, and Tether, again, 60% of Bitcoin is going to be traded into Tether. And so I just want people to understand that.
And not to mention, guess who was talked about being the Secretary of Treasury, or rumored to be Trump's Secretary of Treasury? It's Howard Lutnick of Cantor Fitzgerald. So, and obviously Trump has mentioned he's pro crypto. Well, when you start looking at this stuff, I'm not dumb. I understand the management and the manipulation of an entire system. It's there to fund the U.S. government. It's there to keep our power in place. To keep our standard of living and that type of thing. That's the world we live in. We can't. Like Drew mentioned, this is the cards we were dealt. We just got to be able to deal with it. And I think when you start putting some of this stuff together, you start to realize, wait a second, there's actually rhyme and reason to some of this stuff. It's not just simply all by chance.
Is there ramifications on any of these banks that are holding the short positions that if all of a sudden the price of silver spikes, that these banks would be in a position where they would become insolvent? Is there anybody who's looked at the books of these banks? And I've heard Bank of America has a very large short position, but I have no way of course knowing that. But is there a possibility that a spike in silver would cause some of these larger ones, institutions, to become insolvent?
I think a lot of people point to sort of Ted Butler's work and his idea of this gigantic short position. Obviously, I don't think anybody really knows for sure because they haven't seen the books. And at the same time, if you look at the derivative position on the Office of Comptroller of Currency reports, those big derivative positions, huge notional values, are not just simply the banks. It could be their customers. It could be indexing products. It could be institutions wanting to take certain types of positions that aren't in the commodity itself, but actually in a security or a structured product that their charter allows them to invest in. I think if you look at if you're trying to say, listen, if a bank is, if it's long the metal and it's short the futures, and if you just look at that scenario, and as I mentioned in March of 2020, when you started to have those breaks in the marketplace where all of a sudden the physical was unattainable, and then all of a sudden the illiquidity came into the futures markets, and these guys that are short, even though they're hedged or they're maybe the trades are backed by a physical position, if one side of that locks up, it could cause substantial losses. And that we got to see that happen actually in 2020, both in the gold and the silver markets.
And that's why the only thing I was saying there is, like, if you're these governments and you're looking at the geopolitical situations and the tensions around the world, could the pricing of these commodities be weaponized? And that's the only thing that I'm saying here. Along with what David was talking about, these silver producers and so forth getting together to at least have some type of guaranteed margins. I'm just curious from a geopolitical standpoint that these governments aren't colluding in some way to try to figure out this new monetary arrangement that they expect is coming because of these unsustainable debt levels in the West.
Don, say a bit more there. Weaponized, you're saying the price of the metals weaponized against who and by whom?
Yeah, and I haven't thought this through. I'm just saying, is there a way to weaponize them in a way that, let's just say that, as we're talking about the BRICS trying to back a currency with real resources, that they would be accumulating them in the background and perhaps through the black markets in such a way that when the market finally has to recognize the price, the banks are vulnerable, and at the same time, the reevaluation of their own currencies benefit their position at that point in time. And again, I haven't thought through it clearly. I'm just saying that I know that most people don't talk about it, but I would think that some of these smart people are looking at currency, and especially with what's coming with the sovereign debt crisis, that they have to be looking at these markets in a way that would benefit them when this reset would occur.
I can add something here. I hope it helps, but for gold right now is roughly 1 or 1.5% of the entire financial system. But silver is 0.02%. So for silver to have any meaning as money, it would have to go up astronomical. Well, look at the gold-silver ratio. I mean, for silver to have any real monetary weight where it actually meant something in the monetary realm, it'd have to go to the classic or monetary ratio of 15-1 or maybe 1/10 the price of gold. It just couldn't have any real meaning at this ratio. So could it come back to the monetary sphere? I don't think so. I wish it would on a official basis. On an unofficial basis, yeah, I think as things get more and more crazy in the monetary sphere, you're going to see people selling cars for silver and renting apartments and paying rent and everything else. But that's, going to be the free market or the black market, unless you get a ratio that's more commensurate with them both acting as money and not one just being a commodity and one being money. I mean, Steve makes such a great point with his work that really I've kind of rethought it. Not that, I love numbers, but it's like, okay, when gold starts to get a large margin above the cost of production, now it's acting like money. And I would argue the same thing with silver. Once silver gets above the cost of production, now it's starting to act like money. I believe that it will. But whether or not it'll be meaningful to answer Don's question, I doubt it. But if you flip the coin, excuse the pun, there's nothing more technologically important in today's world than silver. You can't have the war. You can't have a computer. You can't have a cell phone. You can't have any of this stuff without it. So from a strategic perspective, it's almost priceless. You pay damn near anything to get it. So kind of hard to answer. But on the monetary side, those are the numbers.
If I can
and my thinking is when you start to move away from this, I would call it this modern, money, this modern money theory, that you'd move towards we're almost moving towards real assets again. And this financialization of the economy, which has been going on for so long. And when you make that move, as you're saying, these things get revalued in a way that they represent the true value to society. And they become almost invaluable.
Well, David hit it spot on. And really, silver is not money. Silver is the most thermally and electrically conductive metal on the planet Earth. Okay, it's used in all types of warfare. It's in your keyboard, and your keyboard gets ended up in the dumpster in the landfill. So it gets used up. And it's the most manipulated precious metal on the planet. You have big banks, JP Morgan, that gets fined $1 billion a year for spoofing the silver market. They own more than 50% of COMEX. They can drop the market every day. They can raise the market every day in terms of dollars. Okay, silver, you always want to paper trade it. You don't want to hold it physically because there's no money to be made there unless you're buying very large quantities, and it takes up a lot of room. So right now, the focus should be gold, because gold is money. Gold is currency. You can take gold anywhere in the world and trade it in the least volatile currency and have your money go further. Okay, you can take a Krugerrand to any major city anywhere in the world and get the spot price of gold in whatever dollar denomination, any currency you want. Okay, you're going to get the spot price of gold for that Krugerrand. Silver. Okay, silver, if you hold it on a one-to-one basis and you're stacking it physically, you're not capitalizing when the market moves. When JP Morgan says, hey, let's move silver $1.50, you're not going to go to your local bullion dealer and take your thousands of ounces down there and sell it, okay, and capitalize on those situations. So you want to paper trade it. The definition of a dollar is grams of silver. Okay. Your dollars used to say silver certificates on them up until 1962. That's no longer the case because silver's so manipulated. You got big companies like Tesla, Northrop Grumman, Paris. Okay. You got all these companies that can just buy large amounts of silver and stockpile it and then unload it. So if you guys are waiting for silver to go up to 50, I think you're going to wait a long time because they're not going to want the price to go that high. They're manufacturing things. They're building missiles. You think they really want the price of silver at $50 an ounce?
Ginger, the economic term for silver is that it's price inelastic. So the United States military in the year 2030, if silver's $30 an ounce or $120 an ounce, and if there's 6 or 10 kilograms in each cruise missile, the Joint Chiefs of Staffs aren't going to say silver's too high. We want to, we're not going to pay that much. Whatever the price.
Oh yeah. What about you driving around your Tesla? You're going to pay $150,000 for a Tesla that's only worth 50 grand?
Ginger, it's not that much. There's not that much of each amount.
There's 2 grams of silver in your keyboard in front of your iPad. Okay. And it ends up in a dumpster. It gets used up and it's such a small market. You know how easy it is to manipulate this market? It's not going to go to 50 anytime soon, even if gold goes to 5,000 an ounce.
Well, that's what makes a market. Your opinion.
If I could mention, I totally get the idea of the frustration that the physical investor has with the price of metals. Especially watching, Bitcoin and the stock market and all these types of assets hit all-time highs, and we're sitting here basically, holding an asset that has barely gone anywhere. But if it's one of the reasons why I kind of posted a couple, I think it was last week. If you look at gold from not cherry picking, but from 1967, for example, till today, gold's actually outperformed the S&P 500. Not necessarily if you reinvested the dividend scenario, but just simply the price action. There are benefits to this. Yes, the silver market's small. It's definitely impacted. One of the reasons what people may not understand is when there's 1 billion ounces or 800 million ounces mined each year in silver, a lot of those players will hedge that production because they can't take the risk of the price movements going against them. So each year you have a lot of silver coming to the market, and that market is hedging the movement of that silver from the producer to the refiner to the fabricator or the wholesaler or to the retail dealer. So you have a constant ebb and flow of selling that goes on to whoever actually has that metal, which is, I think, a little bit overlooked. And it's something I've tried to bring out to a lot of these promoters and social influencers and it's one of the reasons why they don't have me on very much is when I try to explain this process of how a lot of these markets work. A lot of these players are using finance capital, which requires them based on covenants or lines of credit that forces them to say, listen, the person that's loaning them the money doesn't want to take the risk of that loan not being repaid, and so there's a natural market that's been derived or created for hedging and providing that type of price neutral support. And that the unfortunate thing is that tends to have an impact on the overall price of silver, which is where I see the influence of the paper markets having an impact against the physical asset itself. The unfortunate thing, I think, and this is what the frustrating thing that I was trying to tell people back in 2022 and 2023 was that the unfortunate manipulation of the markets is, it may be market makers, it may be authorized participants, basically working the money flows of an ETF and taking advantage of the premiums and the discounts and NAV and using the silver and creating shares and then delivering shares back and so forth. But it's also, if you really look at the bread and butter of what's impacted the silver market, and I think Drew could talk about this too, is the massive markups that the retail and the wholesale industry did from 2020 to 2023. I mean, a massive amount of money went into their pockets. If the markups weren't as big as they were, you probably would have had a lot more silver absorbed into the market by investors. And that's a fact. And that's unfortunate because now people are starting to realize how much they overpaid and really how much the industry made. That's where the industry or the public has to become aware of how the industry operates. And if we're going to see the investor come back into the market, you have to make this appealable where they have a chance of making money. That's the sad fact that a lot of people are frustrated right now, especially they've held for 15 years or 5 years or the last couple of years. And, silver's gone up a little bit, but now you go to sell and you're not even getting spot in a lot of cases.
Oh, silver is all about timing. Look at during COVID. I was leveraging folks in silver 5 to 1, 3 to 1. All of them got blown out of their accounts when COVID hit. Huge amounts of money gone. Millions of dollars, people's savings gone. Manipulated market killed these people. This is what you have to realize. Silver can move a couple bucks. You can make some money, but it could drop off the deep end and you'll lose your ass. So silver, you want to trade it. You want to paper trade it. You want to be cautious, but you don't want to go all in. I'll tell you that right now. From my experience of leveraging folks in silver for over 10 years, there's very little money to be made there. A lot of high interest loans, collateralized loans, storage fees galore. Brinks is like 1%. The storage fees, the interest, it just doesn't add up. You don't make much money. If you time it just right, you might make some money, but you're better off holding gold, folks.
Let me interject here real quick, Ginger.
Sure.
So if you were following one of the largest players in the silver market got bounced out, are you aware of that?
A lot of people got bounced out.
No. So,
so
Monex was one of the largest players in retail silver. They had what they call the outlet account.
They're all backed by A-Mark.
Yep, they are. And
A-Mark and the collateralized loan company. Okay, these are the guys pushing this. They're the ones ruining folks over these interest rates and storage fees.
So when they got back, they had to liquidate a huge portion of their book. I worked there for a little over a year, 20 years ago. So I was following.
I've done many deals with all those guys, huge deals. Okay, I'm on Palm Beach Island, 60 billionaires. Okay, I know the silver market probably more than anyone in this arena. Besides the paper market, I don't trade equities, but it's the physical side, the leveraging side. If you got any questions, feel free to ask.
I'm just saying they all got bounced up. So the fact that I've always, my opinion's been, one of the reasons is the CFTC came down hard on all those guys and knocked them out. And I think it took a lot of liquidity out of the markets. That's just my opinion.
Well, you can only trade it like 2 to 1 now. So good luck with that. No money.
Yep.
So it's all about timing, like everything in life. But if you want to make money, if you want to focus on wealth, okay, you buy gold. Gold is money. It's where you put your investment earnings so you actually keep up with what you earn. You have to take a percentage of each investment that you have that's denominated in dollars, including all your paper gold and paper silver assets, and funnel it into physical gold. Eagles, Krugerrands, Buffaloes, Kilo bars, whatever you like. You got to have the physical. It's money outside of banking. It's money outside of the electronic system. It's Article 1, Section 10, U.S. Constitution keeps you free, gold, silver. It's right in there telling you to stack it. Okay, this is how your politicians stack it. It's in the Dodd-Frank. So you should be doing the same.
I agree that there's a big difference between trading on the leverage side and owning the physical. I'm not a player that advocates using leverage, because being in the business as long as I have, I've seen a lot of people blow themselves up. I've seen a lot of these so-called gurus and experts that have been interviewed by all these gold and silver podcasters and so forth over the years just get wiped out or wipe their clients out. The advantage of the physical is it's time in the market versus the paper side, it's timing the market. And I think the attributes that the physical market has, like you said, is it's for the public that says, listen, I'm just trying to protect what I have. I'm taking chips off the table. I know this is going to be around. It's not going to go to zero. It certainly lasted through every civilization known to mankind. There's a lot of risk reduction and risk management advantages to owning the physical versus obviously the paper side. But I think
think about it. I mean, silver you sell, silver you trade, gold you keep. That's the name of the game if you understand this business. And if you paper trade silver and you can't make 10% annually on that, then you don't know what you're doing. And 10%, that's inflation. Okay, if you look at gold past 20, 25 years, average out all major currencies, it averages out about 10%. It's there as an inflation hedge. The real rate of inflation is around 10. Gold is there for that purpose. It's the only real hedge out there that your accountant can mark off in its books. A true hedge for cash is physical gold. It's not silver. I rest my case. Ask your CPA, $1 today is worth more than $1 tomorrow. So why would you keep all your assets and earnings in dollars?
Ginger, quick question. What are you seeing with the high net worth clients, their view on
gold? Bitcoin to me is a scam. Bitcoin is highly speculative. Okay, I remember trading Bitcoin for physical gold not that long ago. 2017, 2018, I had gold money accounts. I would take folks Bitcoin for $1,000, $1,200, whatever it was going at the rate, and I would send them a maple, a 1 ounce maple, whatever they wanted. Okay, that's the real price of Bitcoin should be around what gold should be, and gold should be around 10,000 an ounce right now. And that's probably where Bitcoin should be, 5 to 10,000. But to me, Bitcoin was started by the NSA, CIA. It's highly manipulated as well. And you're tracked. You can be hacked. You can be erased, deleted, destroyed. Okay, it's stored on silicon SI chips. You can smash those, break them, steal them. One of the largest holders of Bitcoin is the FBI. There you go. In my opinion, is to keep track of criminals. It's on a public ledger. Gold, nobody knows where your gold's at. You do a gold purchase with any bullion dealer across the country, nobody reports anything. It's there. It's freedom. It's like cash. It's there to keep you free, sovereign. Bitcoin, okay, great. Make an investment in Bitcoin. Go for it. It was like 50 cents not that long ago. And now it's like, what, 90,000? I don't even know where it's at now. You got to take a portion of those Bitcoins, sell them, and buy gold. And if you do that throughout your Bitcoin investments or your real estate investments or your paper traded investments or whatever you're investing in out there, that's all dollar denominated in the end. You got to keep up with what you've earned, right? And the only way to do that is gold, because gold's the ultimate form of money. Alan Greenspan said that, okay, head of the Fed. Gold is the ultimate form of money. And nothing's going to change that.
You read the Life After Google, Gilder's book? Because he is saying that in particular. I'm just curious about
Well, Alan Greenspan wrote a whole article on gold, and that's exactly what he said. He said gold's the ultimate form of money. It's not going anywhere. I mean, think about it. You ever travel the world? You ever been to other countries? Gold is gold, man. Like, you can take gold anywhere, and people are going to accept it. You can't say the same about the dollars. Talk to guys that were over in Iraq, Afghanistan. Talk to real military contract guys. They keep British sovereigns in their pockets. Okay, they don't keep dollars. People don't want dollars. they want gold. So I'm half Turkish. Okay, I come from an old part of the world where they first minted gold coins, so 6,000 years ago. It hasn't changed since the Ottoman Empire days. Gold is gold, so buy a lot of it. Silver is speculative, just like Bitcoin. You don't know where it's going to be tomorrow. It could be $12, like it dropped down during COVID. It could pop back up to 30. You don't know. You can't sit here and say silver is going to go up to 50 in the next year or 2 years or 5 years. You have no idea, because it's such a small market. It's a tiny, tiny, tiny market. Look it up. Any bank, any corporation, I don't care who they are, they can manipulate it.
Question: where do these high net worth individuals see this monetary reset going? Do they see what does it look like, the new currency of these countries transacting with one another?
Gold. Everything's look at the ruble, backed by gold. What do you think is going on with BRICS? Everything's tokenized, backed by gold. Everybody's going back to the gold standard. If you can't see that, I'm sorry. You got to pull your head out of your you know what. I mean, really, all signs point to gold. Look up a 10-year chart of gold. Look up a 5-year chart of gold. Look up a 1-year chart of gold. The trend is your friend. And silver, my friend, I would not put all my eggs in that basket.
And you wouldn't even look at in particular, not looking at the long-term cycles of looking at the gold to silver ratios.
No, I think it's meaningless. I mean, look, they say buy silver when it's, up in 80, drop it when it drops to 40, 60, buy gold. Bullshit. Look at history. Someone was talking about oil. Oil went to negative. Where did silver go? Please tell me. That wasn't even that long ago. Look, you guys, silver is a manipulated you-know-what, and everybody knows it in here. You're selling products. That's great. You can make money on silver. Everybody can. Like I said, if you can't make 10% a year trade in silver, you need to stop trading and go get a job, do something else. That's what silver's all about. You take your earnings from there and you buy physical gold. Gold is where it's at. You should have 25% of your net worth right now in gold. Minimal. Because think about it. Everything's overpriced in dollars. Dollars don't make any sense. Real estate. I got guys building $20 million homes on Palm Beach Island right now. They don't even know how much they're going to make. They have no clue where the market's going. Gold, they wish they would have bought gold a couple of years ago. Okay, you put $1 million in gold a year ago. Now you have 1.5 million. You can't say the same about a real estate deal. You think if you bought a house out on Palm Beach Island for $5 million, you think you're making more than buying $5 million in gold in the past couple of years? I mean, like you said, it outperforms everything. The S&P, you name it, over time. If you would have bought a house in Miami Beach back in the 70s, what do you think it cost back in the 70s for a house in Miami Beach? Like Surfside, where that condo fell down. What do you think? Anybody? $100,000? What do you think? Imagine putting $100,000 in gold back in 1970 versus buying that house in Surfside. Okay, how many ounces of gold could you buy back in 1970 with $100,000?
So, Ginger, how do you trade silver, and let anybody know what you're?
I don't trade silver, and I don't sell silver. If you come to me, if you're some high net worth individual and you say you want to buy silver, I say, dude, you got room for it? You got an extra west wing in your mansion out here on Palm Beach Island to fill up that room full of silver? Because it takes up a lot of room. I'm not selling any paper contracts. I'm not an equity trader. I don't do anything ETF wise with silver. It's not my thing. If you come to me and say you want to buy silver, I'll tell you, fuck off, buy gold. Okay, excuse my French, but that's the truth. You're better off buying platinum. Platinum historically has been higher than gold. Platinum is so constant. It stays like right around 900 to 1,000, right? But historically, it's been higher than gold. So platinum to me is a better buy. It's a better store of value. Okay, it's more rare than silver for one. And if you ask me, you're not going to lose your money.
Hey, Tom, I'd like to chime in. Ginger, we appreciate your passionate reply there. You seem to have a good idea of what's happening. And I would agree that gold is probably the go-to asset, but
I'm one of the top traders in this country, I'll tell you right now. I'm one of the top 5 traders in precious metals, physical precious metals in the United States. If you have any questions about gold, silver, platinum, feel free to reach out.
Oh, it may be, if you don't mind, just letting me talk. We appreciate that you're the big dog, but one of the analysis that I do is energy. So if we lived in a world that was driven by the energy tooth fairy, then what Ginger Hedge says is right. But due to the fact that we are constrained by energy, so energy drives values in most assets. And right now, silver isn't doing as well as gold because you know why, which maybe Ginger overlooked. The cost of production of gold since 1980 is 5 times. Silver, it hasn't even doubled. Well, people don't want to look at that. And so the thing is, going forward, the reason why I do believe it's good to have gold and silver, and if you're going to have a lot of money, a high net worth individual, it would be unwise to buy a boatload of silver. But I think as time goes on, that dynamic is going to change because there's just way too much financial assets out there. And they're backed by basically debt. And so that works when you can grow energy. When you can't grow energy, there's not many good stores of collateral. And I've said this before, the foundation of the financial system, collateral, is the U.S. Treasury, which is a debt. And that just continues to grow. So as the market gets into trouble with energy, so will a lot of the finance and debt. And there just isn't that much gold and silver out there. While gold will continue higher, there's only about twice as much silver in investment form than there's gold. There is more silver out there, but even Ginger said it, it's being thrown away. So my idea of silver is the more mid to longer term. As we get into trouble with energy, there's too much finance and there's not enough energy that's going to settle it. And that's the high net worth individuals don't get it yet. And so this is something for down the road. But I do agree that right now, silver has frustrated people because of there's just it's based on the cost of production. But I see that changing in the years ahead.
I don't, but that's just my opinion. I mean, I know some high net worth individuals that'll buy 1,000-ounce bars and put them under their columns on their porch just for fun as base plates. But hey, what do I know?
Hey, listen, you can have your opinion. And I can tell you seem to be upset because it seems like when people were trading in silver, you got them in silver, they lost a lot of money. Well, that's what happens with leverage. But,
Yes, it does. It's a risk. Silver is a risk. That's why I'm on here. That's why I came on, because silver is a risk and it's a highly manipulated market. Okay. I said, great, paper trade it. Silver you trade, silver you trade, silver you sell. Gold you keep, gold you buy physically. If you're buying silver physically, what are you doing that for? Okay. You waiting for the apocalypse days? Well, I'll tell you what, there's going to be a silver guy on every corner and you can bite off a piece of your gold and go to that silver guy and say, give me a few of those. We all know the story on silver here. I told it to you guys. If someone wants to argue with me and tell me different and talk about production and mining and this, that, I mean, come on. You got to be kidding me, man. I mean, you're just selling silver investments to speculators. It's no different than Bitcoin or Dogecoin or you name it.
Well, I disagree with you. I'll finish up here.
Okay. Well, back up your statement then. If you disagree with me, please tell me what drives silver, because somebody says oil, somebody says this. You got to realize Kamala Harris could wake up tomorrow and say, hey, Jamie, let's bring down the price of silver to $10. And JP Morgan says, no problem. We'll just get fined, $1 billion for doing that. No big deal, because we make $1 billion a day trading silver.
Well, if you say that, then you really don't understand the silver market. You know why? Because if you look at the 50-year chart of gold and you look at the 50-year chart of silver, silver is a little more volatile. But I'm not talking daily or weekly.
A little more volatile? Are you kidding me, dude? Silver is super volatile.
All right. We've had enough of...
I'm sorry, but just to finish, Tom, thanks. The difference is silver or gold has really not gone down below the cost of production. Silver is more volatile because of it's a smaller price. But when you look on a yearly chart or a quarterly chart, silver always tends to bounce off their cost of production. And right now, I just did the numbers. It's like $26, it's $27. And even though it could spike below that, I'm going to probably say that's probably where it's going to bounce off because there's so much demand for it in industrial. So I disagree with him. He can have his opinion, but if we look at the numbers, it's proven itself over the last 50 years, both gold and silver have bounced off their cost of production, and they haven't stayed below that. And so I don't think it's going to change.
And you and I went through that, Steve, in the last interview that we did together, right? You went through the charts, you did the research. I mean, Steve, clearly you haven't been trading silver as long as him, but he doesn't trade silver apparently. So whatever. Anyway, getting back to what we wanted to talk about here. What else is on people's minds that hasn't been brought up yet? We've got some excellent traders in here, some excellent minds like David, like Jim. What else is on your guys' minds right now?
I'd like to just throw it out there. our deficit in a couple of days or a week is going to be 36 trillion. And maybe we could talk about that amongst the participants tonight. It's gone crazy. Just for reference, when Barack Obama came into office not that long ago, not that many presidents ago, it was 9 trillion. And now we're talking 36.
So what do you think that means for the actual markets? And
I think, Tom, it's a direct reflection. Our deficit is a direct reflection of the issuance of treasuries that are coming. It doesn't seem like they use tax revenue to pay off the treasuries. If $1 million of treasuries come due, they borrow $1,020,000 or 1.2, $1,200,000 or something like that to pay them off. They're borrowing the money. I guess you might call it a Ponzi, but they're borrowing more money to pay off the debt. So my point is that we've got more treasuries coming. If we cannot sell the treasuries to investors, now the banks buy it, the Federal Reserve buys it, but if they can't sell the treasuries to investors at the current rate, the current interest rate, the 10-year rate is about 4.4 and the 30-year rate is, call it 4.75. That might mean that the interest rates have to go up to attract, investors to come in, because 5% isn't doing it. When the inflation rate, I think Ginger mentioned the inflation rate, he's right, it's between 8 and 10. And so if you're you're locking yourself in for 10 years or 30 years by buying a treasury, I'm not talking about trading a futures contract. I'm talking about buying the treasury bond or the treasury note. My point is that now we're 36 trillion. And I think Biden this year, I think it's between 5 and 7 trillion that he added this year. I think that's a big deal that affects the confidence of the U.S. dollar. If the confidence of the U.S. dollar trips and falls a little bit, the treasury market's the biggest one we have. It's bigger than the equity market. And the equity market is huge with these big valuations. There could be, a tick down in confidence maybe, and that might send gold higher too.
Tom, one quick thing. Thanks, Jim. I do think you're right. And when Ginger talked about gold headed like a 10% a year, I mean, from 2013 to basically 2019, it fluctuated between, 11, 12, 1,300. It got to a low of 1,050. So it really didn't increase until after 2019, and especially in the 20s. And what happened? Well, the world went crazy. The U.S. Treasury added a whole bunch of money after the pandemic. And guess what? All that money supply, all that debt pushed into the market. In my cost of production of the gold miners, it really pushed up the price. And again, my cost now for gold is approaching $1,900, the total cost, not the all-in sustaining cost. And silver has jumped up. And this is including some of the biggest silver miners like Fresnillo. It's now at 26. Before 2020, it was in the 17 range, 18 range. And so I think as they print more money, as they print more treasuries to continue business as usual, that is going to end up in costing and pushing the price up. But what is really going to make these metals really increase is with that time when the market will no longer readily absorb treasuries, especially as we start to hit these energy constraints that I write about. And so that's when we're going to see the disconnect. No longer will the cost of production of these metals be the driver of the price. It's going to be the inability of central banks to be able to continue to print their treasuries and their bonds. And I think that time is coming in the future.
Steve, when we think about that exact problem, how do you see that playing in, and how does that weigh out with possible stimulus from, let's say, lowering tax rates, bringing innovation back, cutting regulation, maybe let's just leave that one up in the air. I know between you and I, maybe more and or cheaper energy. How do you see that kind of balancing on that other side of these deficits? And does that, really weigh on the other side of it as a counterpoint? to that debt picture.
Yeah, Tom, and I don't want to steal the spaces here. I'll answer and let other people talk or ask questions. We need to understand while the U.S. government has added a lot of debt since the 2008 financial crisis, it's like 20 trillion. The money supply has increased about 15 trillion, the U.S. money supply. The Chinese money supply has increased like almost 40 trillion, 35 trillion. It's double. So it's not just the United States printing money. Everybody's printing money. The issue going forward is we've been getting into trouble with energy, and that's a whole discussion for another day. And the way to offset that is to use a lot of debt. We can't become more efficient because the energy is just getting more expensive to produce it. And so basically all we have to do is print. And so if they say they're going to cut spending, they're going to make the government more efficient, then they're going to just destroy the GDP. And I don't think Trump wants to do that. So even though he says he's going to cut government spending and do all these things, then he's going to destroy the U.S. economy because he can't stop that train. And that's the same thing with China. They've got a serious problem over there. So basically all this is going to continue, and it's very good for the metals because I do not see I don't see the ability of these countries to stop printing. And at a point in time when they can't, I don't quite know what that looks like, but I would be rather holding real assets than a lot of these treasuries and debts and financial assets.
Just so everybody is aware, as the rate of interest goes up, and it can go up to attract demand to buy them, as the rate of interest goes up, the value of the bond goes down. The banks that are holding these treasuries, the Federal Reserve, if they're holding $7 trillion, a bunch of it is treasuries and mortgage-backed securities, they can have a loss in those, a holding loss on those bonds that they've got in their inventory.
Bob, do you have anything to add on the debt picture?
Well, I kind of mentioned it earlier. You have some of the people that have looked at what the campaign of the Trump administration wants to do is going to add just an enormous amount of deficit spending or debt to the system, and that has to be absorbed. And when you start to understand, this tether picture a lot more, and the ways they're going to try and finance this and sell this debt to the public without disrupting the financial markets, because you have to remember when you add more supply to a system, if that system can't absorb it, it's going to expect a lower price to attract more buyers. And so the idea is to try to, they're trying to thread a needle where they're trying to bring more debt to the market without having to force interest rates higher. And I think that's over time, it's a very difficult thing to do. You can obviously manipulate the short end of the curve. You can use, like Janet Yellen did with her fiscal policy, which kind of turned into monetary policy, where they started to change the duration structure of debt and started to really front load T-bills and back off on longer dated paper. And you have to remember what the banking system did was actually they were granted some advantages where if you have your hedge fund and you have T-bills and you want to borrow against it, you can actually in the repo market lend those, provide those T-bills as collateral and borrow 97 cents on the dollar. So there's a lot of advantages to T-bills, not just simply that you don't have the duration risk, but also you have the collateralization, and that's what's been driving these asset prices as well. Even though the Fed has been reducing their balance sheet, you've had private credit creation that's been the driver in money supply and so forth, and pushing higher asset prices. But one thing I was going to mention too, if the gold silver debate, obviously David's been there, done that for 50 years. I mean, he's probably outlasted everybody with this, and he could probably go through this in more detail than anybody. But when you look at gold, and when gold gets too high in price for the nominal investor or for the public, and they want to have some participation in the precious metals, silver then becomes sort of known as poor man's gold. But it typically people start buying silver because gold just basically they're priced out of. And I think that's something that, and you see that in the jewelry market as well, but I think that's something that may come back into, if gold continues to rise, I think people are going to say, listen, I see silver, it's nowhere near its all-time high. And I think that's what's been sort of the driver, especially amongst higher net worth investors out there since August, is you've seen some very, very big purchases of silver in the marketplace for the physical market. And I think it's the idea of looking at the ratio, looking at the relative value of gold. No question, platinum has been a dog. I think it's the only worse performing metal than silver out there. But I think the gentleman was right. I mean, platinum has some real upside, but I think the story with platinum is going to need, the hydrogen fuel cell. It's going to need some antithesis to kind of pick that thing off the ground. Whereas I think with silver, if you do see the continued electrification, you do see the solar panel activity, the smart car technology, all these types of things, and of course we're trying to get sort of our arms wrapped around the Samsung battery idea that can increase longevity and cut down the recharging time and so forth, and be more stable in structure. These are things that build in the marketplace that we may not see today, but down the road, if the price continues to move up, it's one of those aha moments that, okay, that's the reason why it went up. And that's the difficult thing about investing, is you don't necessarily know what's going to be that driver a year or 2 or 3 years from now. But the advantage I think a lot of people do when they go into physical is they're willing to wait that time and not get caught up in the volatility and the trading side of the markets, which can be extremely emotional and extremely disruptive to one's net worth if they get caught up in some of these event-driven and churning type cycles in the marketplace.
Could I ask David a question, if David's still there?
I am still here for not much longer, but I'm here. Go ahead.
Thank you, David. I've kind of got a time value of money question for you. And that is, if you go back, I'm just a couple years younger than you are. If you go back, let's say 40 years, a Ford pickup truck was $4,000. Now a nice Ford pickup truck, they're nicer, no doubt about it. But a nice Ford pickup truck now it's $40,000, let's say, $40,000, and they go up to $80,000. So that's 10x. Okay, a Big Mac used to be $1, and now a Big Mac is $6. That's 6x. The dollar, they say that the dollar loses 7 or 8% a year. So the 1980 dollar, if you bought a dollar's worth of goods in 1980, now you probably need $5 or $6. So just relating to, let's just talk about an ounce of silver. If you say to yourself, it's 2024, it's going to be 2025, and silver through the years, let's say the average between 1975 and 2024, let's say the average price has been, my guess would be $19 or $20. All right. So could I ask David Morgan, what should the price of silver be to be fair? A fair price when Big Macs are $6. Gasoline used to be, I used to work at a gas station. I sold a lot of gas for 28.9 cents a gallon. Gas is about $3. That's a lot more. So could I please just ask just your opinion or your guess on what's a fair price for a 1 ounce of silver, not a silver eagle, but just 1 ounce round of silver?
Jim, you answer your own question. I mean, basically, when I started driving, gas was about 25 cents a gallon, and now 25-cent piece turned into fiat will buy you about a gallon of gas. So has it done its job? Yeah. I expect it to do better on a percentage basis than gold, but I don't think the story's over. And as Bob has said, and myself many times, when this thing unravels further, there's going to be a run to gold, I think, like we've never experienced. I mean, I was there for the 1980. I watched gold go from, I was in the futures market. I had $300 gold, December gold, 300, and it went to $850 on my birthday. I made 300% in a leveraged position. But silver went from, I forget the exact numbers, but somewhere around 10 to 50. So Gold did like 300% in 3 months, and silver did like 500% in 3 months. You'd have to check the charts. You get the right idea.
Sure.
So I think those days are ahead of us. But I want to back up a kind of the big picture. I'm going to be interviewing Judy Shelton on Friday. Tom has already done a great interview with her. I already had listened to it. I might listen to it again before my interview. But, I'm going to hit her with a few things she hasn't been asked before. But one of the things to start off with is a physicist named Albert Bartlett. And he said the greatest shortcoming of the human race is the inability to understand the exponential function. And that's where I think Jim and a couple others talked about, where the deficit was during Barack at 9 billion, and now it's 36 billion or pushing there. So people don't understand.
Pardon me, David, it's trillion, not billion, trillion.
I said trillion, sorry.
That's
so,
right.
Yeah, I'll tell you, I'm going to have to start using the quadrillion here pretty soon. I'll muff that as well. But on a compounding, Judy does a lot with this 2%. And so if you took a penny at the time of Christ's birth and compounded at a 2% per year, a penny would be worth 2.2 times 10 to the 17th power, or nearly 2.2 trillion. And 1,000 trillions a quadrillion. I have no idea what a trillion, if there's even a word. So the point is, and I've got a degree in finance. It's not I got a degree in finance. They never teach you this stuff, that this could go to infinity. And so the reason I think, and this is purely opinion, not anything, factual, but, in the Bible, they had these jubilees about every 50 years. I mean, you can get away with compound interest for 50 years, but you start going into, thousands of years, it gets to be astronomically absurd where it can't be maintained. And we've hit that point now, I think, in the exponential function. And this is what I dislike about Bitcoin. Steve and I have had a small talk about it. I'd like to explore it further, but this halving thing is a function of 2. Anyway, back on point, I think we're at that place where something's got to give. And I don't think that the powers that be are ahead of the curve far enough to be able to say, day after tomorrow, we're closing all banks and here's a new system. Go down to your post office and get your ID, new ID and get into the new system. I don't think they have that kind of control. And this thing could get out of hand. And even if it doesn't get out of hand, it could get perception that it's that out of hand where people run to gold. And when they run to gold, they're going to go to silver next because gold costs too much. They'll go to platinum because the gold dealer's out of gold. So what do I buy? Well, I got some platinum. I'll buy it. They'll do anything. I mean, no one has lived through, and I wouldn't say I lived through real panic, but I would say it got close to it. My futures broker would close her door at lunchtime and lock it, stand in front of her office window and sell Krugerrands physically in front of her office, and she's making more money selling gold she bought that morning in front of her office during lunchtime than she's making being a futures broker. That's how crazy it was.
Well, I think that what I look at is I don't pay much attention to it, but the silver number of ounces to buy 1 ounce of gold is 84 this evening. And it hasn't changed dramatically. It has been maybe 77, but it's been 120 in the last 5 years, let's say, since 2000. And I see that as too high a price, that it shouldn't take 84 ounces of silver to buy an ounce of gold. And I guess that if I would use that to factor into my question that I made to you, my opinion might be that silver shouldn't be $32 an ounce. It should probably be, my go-to ratio is $3,000 gold and $60 silver. That's a gold-silver ratio of 50. That's kind of how I see it as for value. Yeah,
I've changed my opinion over the last few years. I think I'm more in line with you, Jim. I used to, no one knows. I've always admitted that. And unless silver is really perceived as money, which very few do, and we get a panic like I just outlined. I think, 40, 50 is probably where we're going to get to. I don't know. I mean, Steve makes such a good argument. If you really look at the bigger picture, we're looking at fund tickets that represent energy. That's what we're really looking at. And, as far as use case goes, silver's far more usable than gold is. I mean, you could take all the gold and dump it in the ocean and you're really not going to change the world. But you take all the silver out of everything that we enjoy now and the world would stop. So, of course, I am biased, but I think you need them both. But I do think that the monetary aspect of silver, whether you think of it as money or investment or whatever. I mean, you could buy rhodium like Bob talked about a while back. Rhodium doesn't care if you think of it as an industrial high-tech metal or as money or whatever. It doesn't matter. Any hard asset. And I think Don was talking about that. And I didn't say it, but I will now. The shift is starting. The shift is going from crap that we don't need to things we absolutely need, which means a shift back to a super cycle in the commodity sector, which is what I witnessed when I was young. I mean, basically, when I got out of college, the shift had been from stocks doing, everyone perceived at that time to get into the commodities markets and stay away from the stock market. Believe it or not, the Dow Jones had a hard time getting over 1,000 for a long time, if you look at it in the 1960s. So anyway, I think we've got a paradigm shift ahead of us. We've got the exponential function working for or against us, depending if you understand it or not. You got a lot of money in this cryptocurrency sector of people with a lot of greed, in my opinion, that don't understand what that market's based upon. Thinking about this, Steve may like this one, but I've always said on the monetary system, you teach our kids you can't get something for nothing, yet the whole monetary system is based on getting something for nothing. The bankers create, quote unquote money or currency with a keyboard entry into their computer. And then they sell, this debt to the government. And then we have to pay for it as taxpayers. But in Bitcoin, you have to pay something for nothing because you've got to use a lot of electricity and a lot of resources and building and manpower to produce this mining event and get a Bitcoin. But what is its real intrinsic value? It's really nothing. So I don't know. Steve might like that one. I just thought of that one this morning. So I'll turn it back over to you guys.
I guess unless you're Michael Saylor and you follow that 21-21 plan where you leverage out their company and then borrow another 21 billion to just run the price up. I tell people that that's literally the Hunt brothers on steroids at that point.
Yeah,
well said, Bob.
Just hope he can keep making his margin payments.
I know, because in the next 3 years, he's going to buy 42 billion worth of Bitcoin. Half of it's going to be in stock issuance and half of it's going to be in debt issuance. And so, I mean, that's just amazing, because there's no sane businessman that would do that to buy gold. No one's going to go into debt to buy gold. But it seems that's normal for Bitcoin. And, I just looked at Riot Platforms. I looked at their numbers. Their total cost to produce Bitcoin is $128,000. And unfortunately, they're not selling that Bitcoin. Everyone's holding on their Bitcoin. So it's like a gold miner mining 1 million ounces of gold, and they're not selling it. Well, guess what? You got to pay for the cost to mine that gold. You got employees, you got fuel cost, you got equipment cost. So Riot, instead of selling that Bitcoin, putting it on the market, they're holding on to it. And so what they're doing is they're issuing shares. They're destroying the shareholder as a piggy bank to continue mining Bitcoin and moving forward. And so it is a very odd situation. And one last thing, a very interesting thing's happening in India. While they are usually pretty big buyers of silver bars, now with this new Q-commerce, they're starting to see more. They're buying, just like we are in the United States. Americans are the biggest silver investors in the world, bar none. By a lot, we buy more silver than the next 2-3 countries. Now, India, with this Q-commerce, which is internet, it's happening mostly in the big cities. They're starting to buy coins, silver and gold, but they're basically buying these 10-gram silver coins that they actually make in India. And so we've seen a big increase just this year. And so I think that's going to be moving out to the rural part of India. And there's, 1.4 billion Indians. So I think we're going to see a lot more silver being purchased as an investment also in India. So it's going to be interesting times ahead.
Well said, Steve. Does anybody else have anything that they'd like to bring up maybe before we wrap up here?
Can I please ask you personally, you don't have to answer if you don't want to, but do you buy gold or do you buy silver? Thank you.
I feel that I have to get back to evening out a ratio a little bit more. Even though, gold is at an all-time high, I've bought through the years plenty of silver, so I've bought more gold. Not necessarily like recently, but we're just in this time where the more I learn, the more I want to kind of rebalance my portfolio. And for myself, that means that I want to go back or rebalance and bring up the physical side of my portfolio a little bit more. What about you, Jim?
Well, I'm on record saying that I believe that everybody should have 2,000 ounces of silver for themselves and 2,000 ounces for their spouse. And they can have it in any form they want, coins or bars or whatever they want. I've met that goal for myself. I'm real heavy in the mining sector. I think that's where the leverage is. By my makeup, I'm a leverage player, but I've got physical as well. So thank you.
All right, guys. Well, I appreciate everybody's participation again. Bob and Steve, mostly for coming up with this idea and forcing me to put together another space. It's not always my favorite format. I don't like having to police people, but I want to run a respectful conversation. And if that gets out of hand, then we have to rein it in, unfortunately. So again, I want to thank everybody for their questions, their input, and I hope everybody got some value of this. And if you did, let us know, and maybe we can do another one a little bit sooner.
Can I add one more? Can I add one more thing? The gold is up $7 and the silver's up 25.5. Thank you.
Yay.
$25.5, Jim? That's awesome.
Funny man.
Yeah. Thanks a lot, Tom and Bob, Jim and David. Good to hear you again. And Drew. Yeah, you're not going to find these guys really are very honest. And that's the thing. If you're going to deal with people in the dealer industry, in the futures industry, in the silver market, you want to deal with the honest people and who are going to provide you the best prices and services and analysis. And I think that's where it's at. We may not be correct on everything, but we try to be honest. And I think in high integrity, and that needs to be put more in our industry.
I 100% agree. That is paramount. That's the whole purpose of why I started my company.
Well,
in this space,
as somebody with no skin in this particular game, because we don't sell anything, we don't market anything. My dealings with the three of you and Jim as well, my dealings with you guys through the years, I've come to trust you guys. And just because you are, within the industry, I think you guys are great stewards of the industry. And any of my dealings and anybody I know that has had dealings with you guys all have nothing but good things to say. And
thank you.
I appreciate the honesty and the sober and non-sensational look at a really valuable market that can get too sensationalized, and that's not helpful.
Yeah, I would mention too. I think, and Stephen and Drew and I were talking before. We were going to try maybe start doing maybe more of a video series, I guess you could say, on to help the investor try to understand the industry. The gentleman that was on earlier had a lot of good points with regard to silver, how people really don't make that much money holding on to. And part of the problem is the very big markups that the industry has really taken advantage of clients over the years, especially in the last 4 or 5 years. And I think you're starting to see you look at the numbers, and I think Silver Institute just put something out tonight about, I think, a 40% drop in transactional activity in silver investing in physical products this year, and that's no joke. I mean, and I think the sad part is the only way these online companies have really created themselves into a sort of a volume-driven machine that has now created depositories, and the depository business is really a carrot to try to get the transactional activity, and that's really where the money's made. And I think you're seeing risks rising as the industry suffers and profit margins decline, and I think people get more frustrated that if you're not a well-capitalized depository and you're dependent upon your parent company that makes all their money on transactional volume, you're really setting yourself up as a customer for potential risks, especially if you look at the user agreements. You see a lot of these new clauses, these waiver of jury trial clauses, waiver of class action settlement or class action suits and things like that. You got to be careful and just read those user agreements and structured programs and offerings and so forth. That's really what's going to tell you truly what type of risk you're actually taking on. And unfortunately, that's not talked about much.
Well, if anybody has any questions about that, they can go through any one of our discussions, Bob. That's for sure.
Yeah, it's an eye-opening experience for a lot of people when they start to realize. I had an individual that was telling me about their experience with Hard Asset Alliance, where they had gold that they wanted to bring back into the U.S. and Hard Asset Alliance wanted, I think it was about equivalent about $200 or $300 an ounce to bring that back, and they said, well, you can sell it, and we'll pay you $100 under spot. And the problem with a lot of these programs is the client then is almost trapped. They're stuck in a system that now is based on the company's business model, not necessarily the what's in the best interest of the customer. And the difference, I think, with Drew and myself being in the regulated world is that we have an obligation and a duty and a fiduciary care to do what's in the best interest of the customer. And that's what I'm trying to educate people with, is that the spot market, the physical dealer, the physical, that structure has no real regulation. It's unfortunate, but that's just the times we live in.
Well said, Bob. I think we'll wrap up on that. Thanks again, everybody, for your time and for your input. And again, let us know if you want us to do more of these.
Sounds good. Thank you.
Thanks, guys.
Thank you, Tom. Bye.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.